Hi there, welcome to Kneppy Invest. The second, fourth, fifth, and sixth biggest companies on the ASX by market cap are the four big banks. And then just behind those four big banks comes in seventh spot Macquarie Bank. But I won't be discussing Macquarie Bank in this particular video because it's a little bit different than the four big banks. I do have a history with the four big banks, particularly the Commonwealth Bank of Australia. I've only ever banked with the Commonwealth Bank of Australia. My very first real job, not including working at McDonald's as a high school teenager, was with the Commonwealth Bank after I graduated University of Newcastle with an economics degree. That didn't last very long, less than a year. And my very first shares were the Commonwealth Bank of Australia. I bought those way back when I first started investing on the ASX. And I just thought, well, the Commonwealth Bank of Australia, I know this company. And at that point in time, I thought it was good value. So I do think these four big banks are widely held by Australian investors. And there are a few reasons behind that. And I'll talk about that in the next slide. Now, there has been talk around recently, and this has been consistent talk, that the four big banks are overvalued, particularly the biggest one and the highest quality one, which is the Commonwealth Bank of Australia. So I thought I'll go into discussion talking about if I consider the four big banks being overvalued and what I look at when I talk about valuation in regards to these four big banks. Now, in my opinion, the four big banks are not the sort of companies you hold forever. So they're not forever stocks. Now, I have a slight change in opinion in regards to this because I do think there is one bank that you could have in your portfolio for a long time. And I'll discuss that during this video. So what are the four big banks on the ASX? Hopefully, most viewers of this channel already know this question, or this answer, but there might be some viewers who are a little bit unsure about what these four big banks are. The four big banks I am talking about, and I'm going to list these by size, are the Commonwealth Bank with a market cap of about 190 billion. And ever since I started investing, Commonwealth Bank has been the biggest of the four big banks. Coming in second spot right now is NAB with a market cap of about $100 billion. In third spot is Westpac with a market cap of 80 billion. And then bringing up the rear is ANZ with a market cap of about $75 billion. Now, over the last 10 to 15 years, Westpac, NAB, and ANZ have just shifted their positions in terms of size. So sometimes Westpac is the second biggest bank, sometimes ANZ is the second biggest bank, sometimes it's the third, and right now it is the fourth. I've already mentioned that many Australian investors have holdings and significant holdings in the four big banks. In fact, some Australian investors hold all four big banks in their portfolio. Now, I would not do that sort of strategy. In fact, right now, I hold none of the four big banks in any of my portfolios, and there is a reason behind that. Now, some of the reasons why investors would hold all four big banks in their portfolio is because of income. Yet, when you look at the dividend yield for some of these banks, it is fairly low. In particular, the Commonwealth Bank of Australia. The banks are considered low risk. So the likelihood of any of these companies going bankrupt is almost zero. Probably not zero, but it's very, very low. But the thing you also have to look at is the growth of these four banks. And right now, there's almost zero growth. And that is one of the reasons I don't consider the big banks to be the sort of companies you hold forever. Because I would like to hold those companies that are growing through time. And I think there are potential significant headwinds for the four big banks, particularly with the increase in other financial tech companies that might see the market share of these four big banks actually decrease through time. Even though right now I don't hold any of the banks in my portfolio, I have held banks in the past, not for a long period of time, typically for a short to medium period of time. And usually when I do take position in the banks, apart from that initial investment in CBA, which I did hold for a fairly long period of time, the reason I usually take a position in the bank is when I see value. And the way I look at value is this one method. When I compare the current PE or price to book ratio to the historical ranges we usually see for these individual companies. Now, I don't have a typical PE or PB ratio that I use for all the banks because each bank is different, particularly when you compare the CBA to the other three big banks. Now, before we have a look at the current valuations and whether the four big banks are overvalued right now, let's have a look at some of the current valuation metrics and some of the other financial metrics for these four big banks. So right now, the CBA has a PE ratio of 18.54, and I know that is on the high side. I don't have to look at any charts to know a P ratio for CBA at 18.4 is on the high side. For Westpac and NAB, it's around about 15.5 to 15.7, and that is trending towards being on the high side. But for ANZ, 11.1 is actually on the low side. And if I saw the ANZ PE ratio get below 10, and it has recently, that's when I would consider taking a position in that bank. Now to the PB ratio, and well ahead of the other three is CBA with a PB ratio of 2.6. Now Westpac and ANZ have a PB ratio of 1.2, and that has been dropping consistently since the GFC. So that is something else to take mind of, is why the PB ratio of Westpac and ANZ has been dropping over the past 15 years. And at 1.7, we have NAB. Now onto the return of equity, and this is something I do look for most companies. So typically, I want to see a return of equity of around about 15 and above, ideally above 20. And if I see any return on equity less than 10, that is a sort of a red flag. Now the CBA is at 14.3, so that is on the high. We'll say the high side. We'll say a normal side, in fact. But when you look at NAB and ANZ, fairly low at 11.3, 11.2, and that has been below 10 in recent times. And for Westpac, that is less than 8. And I think one of the reasons why Westpac and ANZ PB ratio has been decreasing has been because of a decreasing return on equity over the past 10 to 15 years. Now onto dividend yield, and some people only invest in the banks because of the dividend yield. CBA has a dividend yield right now of only 3.5%. And I'm pretty sure you could probably find some saving rates out there around about 3.5%. And that is absolutely zero risk. Well, maybe not zero risk, but much lower risk than CBA, particularly under the threat that the CBA share price might decrease from here. So, in fact, I would prefer to have a savings account with a rate of 3.5% than invest in CBA right now. Now, the other three big banks have a much better dividend yield, between 4.8% with NAB and 5.7% with ANZ. Now, onto the revenue per share growth for the four big banks over the last 10 years and 5 years. And this is really important because the four big banks are not growing. In fact, when you look at the revenue per share, the four big banks are going backwards. Now, over the last 3 years, we have seen a little bit of growth in the four big banks, but I like to take the longer view. And over the past 10 years, revenue per share for CBA has virtually flat at 0.2, but over the last 5 years, going backwards at negative 0.8%. 0.8. And for Westpac, we're seeing a decrease in revenue per share at minus 1.2. Over the last 5 years, that's minus 3.9. For NAB, over the last 10 years, revenue per share has decreased at 10% per year. Over the last 5 years, minus 4.7. And for ANZ, not quite as bad as Westpac and NAB. We've only seen revenue per share decreasing at 0.9% over the last 10 years and at 1.1% over the last 5 years. So don't expect these companies to be a much bigger company in the future, say the next 5 to 10 years, particularly with that threat of financial technology or smaller financial technology taking market share away from these companies. Now, I'm going to discuss this revenue per share or lack of growth in revenue per share later in the video, because when you look at some of the long-term charts, particularly for CBA, we have seen the share price grow over the last 5 to 10 years, and there is a reason behind that. If I don't forget, I'll talk about that reason when we look at the share price chart later in the video, and that's one of the reasons I have changed my opinion on CBA slightly. Now let's have a look at some of the PE ratios and price to book ratios for the big banks, and hopefully you'll be able to see what I'm talking about. First up is the Commonwealth Bank PE ratio over the last 20 years. So I'm looking at a 20-year history of the PE ratios and PB ratios for all the companies, apart from one. I think I'm not looking at the NAB's PE ratio simply because there was 1 year where the PE ratio got to something like 140, which distorts the whole graph. Now, if we go back 20 years with Commonwealth Bank of Australia, there is an obvious point, an obvious PE ratio where it does look expensive, and that is 18. Whenever the PE ratio of Commonwealth Bank gets above 18, we see the PE ratio then start to decline. So it goes under a multiple contraction period. We have seen that happen about 4 or 5 times in the past 20 years. Back in 2003, back in 2010 for a very slight period of time. Again, during the last few years, we saw the PE ratio of Commonwealth Bank get up to about 23, and that is screaming overvalued. And right now, the PE ratio of Commonwealth Bank is above 18. But on the flip side, whenever the PE ratio of Commonwealth Bank gets less than 12, and we have seen that 3 times in the past 20 years, that is screaming really good value. But beware, the 2 times it has happened, we have seen the American economy in a recession. So that gray area is when America, or the United States, is in recession. So back in 2008, we saw the PE ratio, Commonwealth Bank saw their PE ratio get as low as 8. And during the COVID-19 financial panic, the PE ratio of Commonwealth Bank got as low as 11. And there was a slight period, probably about a 6-month or year period in 2011 and 2012 when the Commonwealth Bank PE ratio was less than 12. And in fact, I actually did take a position in Commonwealth Bank of Australia back then just based off value. So if I ever see the Commonwealth Bank of Australia PE ratio get less than 12, that would be a buy for me in my investing strategy. If I see the PE ratio of Commonwealth Bank get above 18, that would be a sell based off my investing strategy. And right now, the Commonwealth Bank PE ratio is higher than that 18 level. And I probably would have to agree with those analysts who are saying that Commonwealth Bank of Australia right now is overvalued just based off their PE ratio. Now, there is an argument. I have heard this argument quite often, that for the banks, you should be looking at the price to book ratio, the PB ratio, instead of the PE ratio. So I'm including both in this video. And to be honest with you, I look at both when I am looking at the value of the 4 big banks. So this is the Commonwealth Bank of Australia PB ratio history, again, going back to 2003. And the PB ratio for Commonwealth Bank of Australia fluctuates between 1.75 and 2.75. So just like the PE ratio, whenever we see the price to book ratio of Commonwealth Bank of Australia get above 2.75, that is probably screaming overvalued. And whenever we see the PB ratio get below 1.75, that is probably screaming out good value. And the only 2 times, apart from 2003, where we have seen the PB ratio of Commonwealth Bank of Australia get below 1.75 was during those recession periods in the United States, back in 2008 and 2009, and also in the early parts of 2020. And right now, the PB ratio of Commonwealth Bank is just under 2.75. So right now, not screaming overvalued, but getting very close to the point where you might say this bank is overvalued. Now onto the other 3 big banks, and because in my opinion, and this is a commonly held opinion, that the Commonwealth Bank of Australia is a higher quality bank than the other 3 banks, I have slightly lower trigger points for the PE ratio and the price to book, and that will become fairly obvious. So instead of 18 and 12 for the PE ratio, for the ANZ Bank, for NAB and Westpac, I think I have a PE ratio range of between 16 and 10, and it has worked really well in the past. In fact, back in 2016, I took a position in ANZ Bank because their PE ratio fell below 10 for a brief period of time, and then during 2016, the PE ratio for this company went from about 9 to back up to above 16. That is in 1 year period. During that 1 year, the share price of ANZ Bank increased 50%, and that is the only time I have held ANZ Bank shares. So whenever the PE ratio of ANZ Bank gets above 16, that is probably saying the bank is overvalued. We have seen that happen 3 times in the past 20 years. And whenever the P ratio of ANZ Bank gets below 10, that's a possible good value level for this bank. And we have seen that happen about 5 times in the past, and it actually happened quite recently for a very short period of time. So, of course, we saw it during the GFC. ANZ P ratio fell below 10 for a long period of time. It happened again during 2011 for a short period of time, during 2016, during the COVID-19 financial panic, and then again recently for a very short period of time. And right now, the P ratio for ANZ Bank is just above 10 at 11. So I don't think, based off the P ratio, that ANZ Bank is overvalued. In fact, I'd say the complete opposite. If anything, ANZ Bank might represent fairly good value right now, just looking at the P ratio. Now onto the PB ratio for ANZ Bank. And when you look at this particular chart over the past 20 years, there's one obvious thing that's also true when you look at Westpac's PB ratio history. So prior to the GFC, the PB ratio for ANZ Bank was routinely above 2. And then during the GFC, it fell below 2. And since the GFC, it's really struggled to get back above 2. In fact, whenever it gets above 2, that is an overvalued signal. So I'm not sure what's been happening, but I do have a hypothesis, and that is around the return on equity. So over the last 20 years, return on equity for ANZ has been dropping, which means that the quality of ANZ Bank has been dropping. It's a lower and lower quality bank over that period of time. Hence, the PB ratio has been dropping. So if you look at return on equity, it has been dropping for this company over the past 20 years. So in fact, having sort of a trigger, a high trigger and a low trigger, is a little bit different than the P ratio, because I've got the high trigger for the PB ratio from the ANZ Bank at 2. And right now it's well below 2. In fact, it hasn't hit 2 since 2015, and my low point, sort of the undervalued point, is 1.25, and it hit or went under 1.25 during the GFC. Also went below 1.25 during that period in 2016 when the P ratio went below 10, and ever since the COVID-19 financial panic, the PB ratio for ANZ Bank has struggled to get back above 1.25. It went above 1.25 in 2021, but has stayed below ever since. So I don't think looking at the PB ratio and using my strategy actually works for ANZ Bank, and also doesn't work for Westpac, which I'll talk about in a second. I have not included the PE ratio history for National Australia Bank because there was 1 year here where the PE ratio went to like 140 and just distorted the whole graph. So I've decided not to look at it, but very similar to ANZ Bank, whenever the PE ratio gets above 16, that is a sign that maybe NAB is overvalued. Whenever it gets below 10, that is a sign that maybe it is undervalued. Now onto the PB ratio for National Australia Bank. And just like ANZ, prior to the GFC, National Australia Bank's PB ratio was quite high, consistently above 1.75. And then ever since the GFC, we've seen the PB ratio for National Australia Bank sort of hover between 2 and 1.25, fairly similar to ANZ. But unlike ANZ, I don't think there is a significant trend line down, particularly if you exclude prior to the GFC. So ever since 2008, 2009, the PB ratio for National Australia Bank is going sideways. So whenever I see the PB ratio for National Australia Bank get towards 2, that would be a signal that is becoming overvalued. And whenever the PB ratio for National Australia Bank gets below 1.25, which it did during the COVID-19 financial panic, in fact, it fell all the way down to about 0.8, that is a signal that National Australia Bank might be undervalued. And right now it's at 1.7, sort of in between 2 and 1.25. Probably suggesting that NAB is neither undervalued or overvalued right now. I forgot to say that in the last slide. Now onto Westpac. Now this is the P ratio, and fairly similar to NAB, where there was a period of time when the P ratio went really high, but for Westpac, that height was around about 38 back in 2021. So you can just see how it distorts the P ratio slightly here, but it's not as extreme as what we saw with NAB. And fairly similar than ANZ and NAB, my two trigger points when it comes to possible overvaluation and undervaluation are 17 on the high side and 10 on the low side. So for Westpac, ANZ and NAB, whenever I see the P ratio of those three banks get below 10, I do get a little bit excited and think there is potential that those three banks are undervalued. So just like those two other banks, we don't often see Westpac's P ratio get below 10. In fact, it has only happened 3 times in the past, and 2 of those times was during the American recession, back during the GFC, back during the COVID-19 financial panic, and then also back in 2011 and 2012. 2011 and 2012. And then on the high side, whenever you see Westpac's P ratio get above 17, that could be a sign that the company is overvalued. And right now, Westpac's P ratio is hovering around about 15.5, which is just below 17. So I wouldn't necessarily call Westpac overvalued right now, but it's definitely not undervalued, just based off the P ratio. And just like ANZ's PB ratio, you can see a bit of a downtrend with Westpac's PB ratio history. It's been falling ever since around about the GFC, when the PB ratio got as high as 3.5 just prior to that. So that could have been a sign that the bank was overvalued, and we have seen it just drift lower and lower through time. And really, the PB ratio for Westpac has really struggled to get above 1.5, even 1.25, just like ANZ. So I don't use a PB ratio for Westpac, just like I don't use it for ANZ, because it does look like there is a bit of a downtrend when it comes to this ratio. And in my opinion, this is just my opinion, this is probably a sign that the quality of this bank has been deteriorating over the past 15 years, just like ANZ. Now let's have a look at the charts for all 4 big banks. We're looking at the monthly chart going all the way back to 2002. And there are some troubling signs for a few of these banks, but there is one bank where I'll have to slightly change my opinion, and that will become clear. It is the highest quality bank. And when you look at the chart, it's actually a really good looking chart over the past 20 years. Now on to Westpac. So from 2003 all the way through to about 2017, it did look like Westpac's share price was in a nice little uptrend until around about 2017, when the Westpac share price came under pressure. In fact, the share price reached a high of about $40 back in 2015. $40. Current share price is struggling to stay above about $24. So the share price has dropped a lot over the past 7 years. In fact, you could say there is a well-defined downtrend developing. If you go back to all the monthly highs we have seen over the past 7 years, each successive high is lower than the previous high, and that is still continuing to this date. So right now, just like I think the quality of this bank has been deteriorating over the past 20 years, you'd say based off the chart, the monthly chart, the share price and the market probably agrees with that opinion or that hypothesis, that the quality of this bank has been getting worse over time. Now onto ANZ Bank. In fact, I'd probably call this chart a little bit more ugly, little uglier than Westpac, because back in 2006, 2007, the share price of ANZ Bank got as high as $31, $32. You can see a really nice run up in the share price for this company back in or between 2003 and 2007. But that high of the share price in 2006 and 2007 of about $32 or $31 is actually higher than when the share price is right now. So if you bought the ANZ shares back in 2006 and 2007, the value of your holding in this company has decreased during that time period. So that is the sort of thing you don't want to see for a company you have held for about 15, 16 years. Now, you might have got a lot of dividends in that time, but preferably, I like to see the share price of a company I own increase through time, and the dividends a company gives back to shareholders increase through time as well. And if we take the period between 2006 and right now, the share price has done absolutely nothing. But doesn't mean you can take advantage of those situations when ANZ Bank looks cheap. So remember, I took a position in this company at the start of 2016 when the P ratio went below 10 for a brief period of time. The share price at that point was $22. And then during 2016, the share price of this company went from $22 to $33. That's a 50% return in 1 year for a bank. That's a phenomenal return for a short period of time. And that's why I do and am willing to take positions in the banks for a short period of time. And in my opinion, a 1 year period of time is a short period of time. So at this point in time, just by looking at the chart, this is definitely not sort of company you want to own for the long term. And to be fair, that's even truer for NAB. This is, again, the 20-year monthly chart for NAB, and the share price has gone absolutely sideways over the past 20 years. So 20 years ago, the share price was actually higher than it is right now. So when I started this particular chart, it was actually back in 2002. Share price was about $34, and the current share price for NAB is about $31.65. But just like NAB, just like Westpac, if you do see good value, and you can see during the GFC, the share price of NAB fell all the way down to $15, and during the COVID-19 financial panic, share price of NAB fell all the way down to about $12. That's the time to take positions in these companies when there is some good value, because after those particular periods of time, the share price of NAB went on a fairly good run. You would have seen pretty good returns. But again, just like ANZ, just like Westpac, I don't consider NAB to be the sort of company you own in your portfolio for the long term. Even though it gives a nice little dividend, that dividend won't grow, more than likely over time, just like the share price has not grown over the past 20 years. Now on to the Commonwealth Bank of Australia, and to be fair with the other three banks, to be fair with Commonwealth Bank of Australia, I think it might be a little bit unfair to compare Commonwealth Bank of Australia with those three other banks just by looking at this chart. And I've always considered the Commonwealth Bank of Australia to be the highest quality of the four big banks. And when you look at this chart, it is completely different than the charts of the other three companies, because the Commonwealth Bank of Australia share price, when you look at the monthly chart over the past 20 years, has been in a well-defined uptrend. The share price keeps on going up. We have seen those periods of time when the share price pulls back, particularly during those recession periods in the United States, during the GFC, and also during the COVID-19 financial panic. And both of those times, the share price dipped below the longer-term moving average. I think that moving average is the 150-week moving average. You can see the share price fell below that 150-week moving average for a short period of time. I'm talking about 4 months or even 4 or 5 months during the 2020 period. And that was telling us that there might be some value. That could be the buy the dip opportunity for Commonwealth Bank, because the share price keeps on going up for this company. In fact, right now, or recently, the share price did reach an all-time high, which is unusual for the four big banks. So again, I think it is a little bit unfair to sort of put Commonwealth Bank in the same category as the other three big banks. Now, in saying that, you could ask me, now the revenue per share has gone sideways for the Commonwealth Bank over the past 10 years. So this company is not increasing their revenue per share. So why does the share price keep on increasing? And one of the reasons behind that is, even though the revenue per share has not been increasing for this company, the profit or earnings per share has been increasing, because the margins of this company have improved over the past 20 years, maybe because they have shut down some of their regional outlets or malls, or not mall stores, or whatever you call it, their regional banks, that sort of thing. They've improved their margins, and that's why the share price has continued to increase, even though revenue has gone sideways. So my main wariness when it comes to the Commonwealth Bank of Australia is whether they can continue increasing their margins for the foreseeable future, because I think they'll have to for us to see the share price rise from where it is right now, because the P/E ratio is above 18. It's on the high side. In fact, it's above that level where I would consider that the company's shares are possibly overvalued. So that's my one negative thing about Commonwealth Bank right now, that it is potentially overvalued. If I saw the share price dip below about $75, that would be my buy-in price. Now, thing I have not mentioned is that threat of the United States going into recession. And the last two times the United States went into a recession, we saw a significant decrease in the Commonwealth Bank and the other three banks' share prices. Will that happen again? Now, whether the United States goes into recession, some say it's a fait accompli. I think it's still up in the air. I think there is a bit of uncertainty when it comes to whether it does move into recession. I think it's becoming more likely. And if it does, will we see a significant drop in Commonwealth Bank share price? I think it's possible. only possible at this point in time. But again, my buying price for Commonwealth Bank would be around about $75. That's all I have for this video, looking at whether the four big banks are overvalued right now. I think there is some validity to the belief that CBA is overvalued right now, but I definitely don't think you can have that same thought about the ANZ, particularly with the PE ratio just above 10. If the PE ratio of ANZ gets below 10, that could be a screaming buy. That could be the sort of times when you might consider taking a position in the bank, just using my investing strategy, because my investing strategy is a little bit different than other people's investing strategy. So I'd love to hear your opinion. Do you hold the four big banks in your portfolio, and do you consider selling them or buying more? And if you do consider the four big banks to be a long-term hold, why do you have those thoughts? I'd love to hear different opinions than my own. So leave your opinion in the comment section of this video. Otherwise, I am not a financial advisor. That's very important for this video. So even though I use this strategy, doesn't mean you should use this strategy yourself. It's only based off my risk profile and my investing strategy, why I don't hold the four big banks for the long term, particularly those three smaller big banks. And if you do need professional advice, find someone who's qualified who can speak to your own financial needs. That's it for this video. Have a good day. Bye.